talking a little bit earlier about financing and how to finance mortgage note deals. The company Fund and Grow, who are like specialized in helping real estate investors get 0% interest credit cards, which is a little bit scary if you run up these credit card balances at 0% interest. Well, 15 months later, the bill comes due. And if you don't pay it off in full, then you're going to get hit with a 20+% interest rate. That's very challenging, of course, to run that balance up over time and then have to pay it all at once. But if you do it right, 15 months is a pretty good window of opportunity to turn a non-performing loan around. I won't say it's guaranteed, especially if you're in a judicial state and have to go through the foreclosure process. But 15 months is a good amount of time if you're able to write a check on a credit card. And that's the main difference is you're not going to be able to buy a mortgage note by swiping a card. I know from experience, our payment processor Stripe originally thought that our business was selling investments. We're selling education in a community, but they saw real estate mortgage notes and thought we were actually using Stripe to transact these assets, which that's against their policy. And we had to go through their whole dispute process to make sure that they understood we weren't selling mortgage notes through their platform through Stripe. That's out of the picture. But if you're able to write a check on a credit card, definitely risky play to acquire loans with bank financing, potentially at 0% interest rates, if you're able to get those credit card deals. So a couple moving parts there, the 0% rate for 12 to 15 months, check writing ability off of your credit card, or if you can do a cash withdrawal at the same 0% rate. Most of the time, these cards have a lot of specifications around balance transfers and cash advances, and it's either a different rate or it doesn't qualify for the 0% as soon as you try to do a cash advance. But that's one way to leverage financing to buy mortgage notes. Another way, my hometown bank has a product they call the Easy Line of Credit. And I originated an Easy Line of Credit on my account. We did it like 5 years ago or so. They gave me a $50,000 unsecured line of credit at prime plus 2%. So at the time, it was a 5.5% loan. And it was pretty decent. Now it's like 9% plus. So it's not quite as attractive as it used to be to use that line of credit. However, it is flexible cash that can be used to deploy into investments. And at least with the product that they run, if I pull up my mobile app, the Easy Line of Credit is next to my checking and my savings accounts. And I can just transfer 50 grand in my checking and then use those checks as I would normally to fund investments or whatever else you've got. So I would recommend, especially with the smaller banks, if you're looking to finance note deals, to see what type of products they have. Nowadays, some are prime minus points. So it's possible you could find a deal 6-7% for an unsecured line of credit. Not too bad. I don't think you'll find that from like the Bank of Americas and the Chases of the world, but possibly from, your local credit union or your local hometown bank. There could be some possibilities there. It is unsecured because there's no, real estate securing it, but you are signing off on that and you're going to be on the hook if you default. So that's another way. Finally, especially for first position loans, there's a couple of different options to borrow money secured by an existing portfolio. I haven't seen any for second position yet, but I think with the right relationships in place, it could definitely be a possibility. It's really just the banks, the secondary market when it comes to non-performing loans, especially because they're used to lending on real estate. They've got their whole process built on analyzing the borrower and the property, underwriting real estate deals. And when you abstract that to become a mortgage note, then all of a sudden it's just a little bit outside of their comfort zone. But I think there's absolutely possibilities there. And I know that PPR, Dave Van Horn, they have a huge line of credit with their main bank lenders that they use on an ongoing basis that is basically, they called it personal relationship product. It wasn't something off the shelf. It wasn't even called like a warehouse line of credit. They basically had a banking relationship that they'd been working with for a long time that saw the track record and the business that Partners for Payment Relief, that PPR does. And we're able to extend a huge line of credit to them at very attractive interest rates so that they could get more volume through their platform, get more deals done. I believe that Aspen Funds has a similar setup where they've got a huge warehouse line where they can tap that either when they're in between offerings with investors or, kind of to smooth out the gaps between their funding rounds. And I would always rather borrow money from a bank at a decent interest rate than have investors on the hook. I think that there's either way some challenges. You have to have, especially for these bigger lines, gap accounting. You have to have your accounting audited on an ongoing basis, at least annually for most, at least the commercial deals that I've been a part of. But you're not doing quarterly calls and having investors investors call you because they're concerned about something that they're really not in the business anyway. And that's the bank's perspective. They know when they do their underwriting that they can trust you to run a great business. And that's why they're writing the line. And then at that point, you're able to use it for permissible uses that you've negotiated with the bank. I think that's probably the best way to finance note deals, is by using an existing banking relationship to really communicate your value, your business model in a way that they can understand, so that they can see how lucrative notes can be as well, and then participate in it as a lender. So those are the 3 or 4 ways I think you could leverage financing, buying loans. And at the moment, the best way is the bank side.
Nobody is talking about the revolution happening in real estate, where regular investors can earn great profits while helping homeowners that the banks have failed. Join the movement and start your journey into note investing at FIXnotes.com.